So welcome. Thank you for deciding to go ahead and join this course. What we're going to be covering in this part one is we're going to talk a little bit of an overview of what 1099 reporting is and go a little bit about what the purpose of all these 1099s are. We'll talk about when to file the 1099 and the forms, so the timing of when to file it, as well as how to file them and where to file the forms. We'll cover who gets that 1099 and some of the exceptions as to who shouldn't get a 1099. So that's going to be our purpose and our goal for today, and we're going to go ahead and jump right into that. If we look at the overview for 1099 reporting itself, we have to know that, well, first of all, it is commonly a little bit misunderstood. So there is a lot of misunderstanding of the requirements related to 1099 forms, and especially as it relates to independent contractors. So we'll cover some of that being the most common type of 1099 that we just think of whenever we think of 1099s. And as we look over the past several years, there's been a lot of new requirements and legislation put in effect and also removed, which continues to add to the confusion, unfortunately, regarding the requirements. So we're putting this together for you in order to assist you to form a better understanding of what is required for you. The bottom line is a lot of this legislation and the requirements, they're always changing. So in the 1099 course we've developed, we have 3 parts. So think of it as a very comprehensive guidebook. Part 1 that we're in right now, we're just covering a lot of the rules and the requirements. Part 2, which I definitely encourage you to go ahead and continue through the rest of these, is going to cover all of those forms, all the specific forms and all their specific instructions and rules. And then Part 3 is going to talk about compliance, penalties when things don't go according to plan, and some additional reporting. So that's everything in this full 3-part course. You are certainly welcome to look at the manual. You'll find that at taxedge365.com/canopy. And by the way, if you have any troubles at all, try small letters in there. It's a technology thing, but that's where you'll find the course manuals. So as we look at the reporting requirements, and the IRS has implemented a variety of these requirements for anyone engaged in a trade or business. What we're dealing with are ones contained in the Internal Revenue Code section 6042 through 6050, and they generally require a variety of information reporting requirements. Code section 6041 requires information returns to be made by every person engaged in a trade or business, so that's an important part. You can't have to worry about these if you're just an individual, is why they said engaged in a trade or business. And that's one of the things that you have to, make sure. And then generally more than $600. And we're going to continue defining that, so that you'll find out isn't so much a general rule after we start slicing and dicing it. But just think of it in a course of trade or business and generally more than $600. As we look at what has changed over the years, that's kind of the only thing that remains constant is change. We have seen many of these that affect 1099 reporting. Now, most notably, this happened, of course, now it's been a few years ago, back in 2010, when the Patient Protection and Affordable Care Act was signed into law back in March of 2010. It made some extremely burdensome requirements for 1099 reporting. It was so over-the-top burdensome that it was actually the IRS that was petitioning to Congress to say, hey, guys, this is just not even going to be possible to keep up with. It also was, a significant uproar from the business side and from chambers of commerce across the U.S. It was too much of a burden it would have placed in record-keeping reporting. It basically was that you would have had to give a 1099 to everybody for everything, and just the amount of volume of reporting, it was over the top. So they did go ahead and they changed it, and they said, okay, yeah, we'll take that one back, but they added other things in. When we had one with the Small Business Jobs Act of 2010, what they did with that one is they started increasing the penalties. They want to keep increasing these penalties to encourage compliance. And then in 2015, we had another change, and that increased penalties again. It doubled almost all the penalties as they were. And then in 2016, the Appropriations Act started requiring earlier due dates. Now, that was back starting in 2017, where to the IRS, we used to have a little more time to report. Well, they said no more. We want all these forms by January 31st. So it did change a lot of that. So the bottom line, we know that it's kind of the trending. We know the only thing that feels like it's constant is change. But as we look at the trending, it seems that it's going to be a continuing trend that they want more and more reporting so that they can try to keep on top of what they feel is the underground economy in a sense. So what would be the reason they were so interested in all this reporting? Well, we have to take a step back and talk a little bit about something called the tax gap. So what is this thing called the tax gap? It's the difference between the total taxes owed and what actually is paid. The most recent report we have is back in 2016. They do this only about every decade or so because it is a pretty major undertaking. It covers the years 2018 through 2010 in this last report they did. But the idea is, okay, let's just look at what that looks like. They do a graphic of it, and I know this is all small print, so it's not that you have to necessarily know all these tiny details, but we're going to just extract some important little facts out of there. If we look at those years reported, there was a significant amount of taxes paid in, $2.3 trillion. But there's also a very big number when we look at what the tax gap is, $458 billion. That is the difference between what was paid in and reported properly versus what should be. So if we look at the rate of compliance and alternately you can say non-compliance, there's a pretty high rate. It's a voluntary tax system. Most everybody is complying really well. So another way to look at that is, well, if we look at compliance rate alone, when information is reported on W-2s, there's a 99% compliance rate. It's amazing. If it's reported on W-2s, it always ends up being reported and paid on taxes. If there is no, let's say W-2 reporting or reporting, there is a amazing 56% misreporting rate. So the IRS isn't necessarily far off in their belief that there is what they call it an underground economy or a significant amounts of income that's not being reported properly. So the way they change that is force information reporting, or in a way it's kind of like babysitting. You're telling what amount is that you see that you're paying to somebody else so they can watch and make sure that shows up on that person's return. So here's the purpose really of information reporting in a nutshell. They, of course, have valid concerns that all income is not being reported properly. And as you can see by the tax gap information we just showed, it is a valid concern. If you look at underreporting it represents a very large portion of the total tax gap, then that's where they're trying to force a lot of compliance. The answer is basically to require more aggressive information reporting, and in addition to more aggressive information reporting, if you increase the penalties and keep increasing penalties, it gets to a point where people are incentivized to go ahead and comply with that information reporting. So here's kind of the background. We're just setting the stage more so of, why is it that we have to do all this information reporting and why it seems that as time goes on, we have more and more that we have to do. So now that we've covered kind of some of the, I guess you can say, the underlying reasons, then we're going to go ahead and start covering a lot of the things that you're definitely interested in why you're attending. Is we want to know that what the, when to file, how to file. We want to know what to do right so we can do that correctly and we can help our clients to do that correctly. So when we look at the reporting deadlines, and again, we're going to talk about exceptions as we go along. Generally, we have to give for 1099s to the payee or the person who's going to receive this reporting form. We have to give it to them by January 31st. Normally, we can give the information to the IRS by February 28th, so they give us an extra month. And even better, if you're filing them electronically, you can go 1 month later by March 31st. Now, there are some really big exceptions to this, and of course, before you worry too much, he's thinking, well, wait a second, earlier you said something about an earlier date. We're going to talk about that here in a moment. So generally, we're talking about most 1099s, which there are numerous 1099s, and in fact, part 2, we cover all those different 1099s. Generally, to the payee or the person you're giving it to, January 31st, to the IRS by February, unless electronic, you get longer time. However, when we had new changes that were rolled out here just a couple years ago, they said, okay, that's well and good, but if you happen to be reporting on a 1099 miscellaneous, box 7, so that's your non-employee compensation, if you're using that box, we want you to report it earlier. So if you're doing a 1099 miscellaneous for any other purpose, box 2, box 3, whatever, you can still use those same due dates, but if you have a 1099 miscellaneous box 7, you will have to send to the IRS by January 31st, electronic, paper, they don't care. everything by January 31st, as well as W-2s. Those were upped as well. And I know this is more covering 1099s, but W-2s and 1099 miscellaneous box 7. And if you look at that, that is the most used, most commonly used type of form, most commonly used box. That's what everybody thinks of. In fact, when they think of 1099 as just that one purpose, it's going to be January 31st. And for all, this is not just these particular ones, but all forms and all of everything, if we say January 31st is the due date, if it falls on a weekend or holiday, they're going to give you the next workday. So I believe this year, actually, February 28th may be a weekend, so that's just going to push it to the next date. But it is always, for these two specific ones, January 31st, and most everything else ends up being a little bit later. Now, you can, let's say that there's just not a human way to get that done. It's not possible. You can't get it done in time. There is an extension available. This is one of the things I find a lot of practitioners maybe don't know about, and it can certainly ease some pain there of getting it done by January. An automatic extension is available. It only allows 30 days. It's not like our tax filing extension that gets 6 months, 30 days. But hey, February may be a little easier than January 31st if you're in that category of the box 7 of miscellaneous form. 8809 is the form. It has to be filed before the due date. So before the January 31st, if that's what you're looking for. There is an additional 30 days beyond that you can get. And to do that, you would file another 8809, but this is only for some sort of a hardship. So an illness, casualty, catastrophic event, or they consider a first year, like this is the first year this business has ever had to try to put these together, they will go ahead and grant that extra time. So you do the first one for 30 days. So let's say you are doing the 1099 miscellaneous box 7, gives you to February. You would file another 8809 if it was your first year. You could have till March. And this is only, by the way, for sending to the IRS. They still want you to send to the recipient, the person who's supposed to get the 1099, still by January. So that's the catch there. You can also use 8809 for a variety of other 1099 forms. I know we just talked about the miscellaneous box 7, but it's a variety of forms, even W-2s. I mean, a lot of people may not know you can get an extension on that due date for filing the W-2s with the Social Security Administration, or W-3s, 1042 forms. There's a lot of different ones you can use, and about every type of 1099 is available to have an extension if need be. You can file those online through the FIRE system, and we'll talk about what the FIRE system is, or you can send them by paper. So 2 different ways that you can ask for that extension as well. And to show you what that form looks like, and this gets updated periodically, they kind of streamlined it a little bit now for, you'll see the top. The way you tell, by the way, on any form or version is in the upper or the very lower corners. It'll tell you when that form was released. So this is a pretty recent rendition of it, but this is the one you would want to use for this filing year if you wanted to get some additional time. And you can see there's a lot of different check boxes in here. And we'll talk about a little bit what this NEC means. So 1099 miscellaneous reporting NEC only. Non-employee compensation is all that means. If that's where we talked about box 7, if you're reporting non-employee compensation only, they know, hey, normally you're supposed to be due by January. So they kind of get an idea where the new deadline is. So it's a lot for them to keep track of the 2 different deadlines, you can say. So I know that's a little bit about when to file. The main thing to keep in mind is if we're not talking about the 1090 miscellaneous reporting that non-employee compensation, for everybody, for all the other forms, for the most part, it is January 31st to the recipient always, and then February 28th for everything except for that miscellaneous, NEC. That's going to be by January 31st to the IRS as well. So we'll say that's the generals, and then of course the exceptions. If you are interested in my manual, there is a chart that lays out every single one of the due dates for every single one of the forms, and we're going to cover some of those as well as we get into part 2.